rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
In the world of investing, many investors focus solely on returns, but the costs incurred along the way can significantly impact their bottom line. Today, we're joined by Munaf Mukadam, a certified financial planner at Gwedish Mahura Investments. We'll explore the various forms these costs take and strategies to mitigate them effectively. Before we start, please don't forget to follow us on Spotify and Apple Podcasts, share this podcast with your friends, and download our episodes for easy listening on the go. Your support helps us grow. Welcome to the podcast, Munaf.
Hi, Tommy. Thank you. Happy to be here.
Let's start with the basics. Why are these costs such a crucial aspect of investing in your experience?
So costs have a direct impact on the return that the investor would generate overall. So there's two things I think that's important to point out. The one is that, which is more apparent, which is that, if you have a 2% cost and your investment generates an 11% return, then after cost, you would have a 9% return. Compare that to an investment portfolio where there's a 3% cost, it will then reduce your return to 8%. So that part is quite apparent, and I'm sure it's quite easy to understand. The part that I think is often overlooked is in this example now where you've generated 11% and the cost is 2% versus 3%. In that first year, the additional percent that was deducted from the investment as a fee, that isn't available in the second year to generate the return. And in the second year, there's again an additional percent that's deducted. And then in the third year, you've got the first year's portion that was deducted, plus the potential growth in the second year, plus the percent in the second year that isn't there in the third year. And then what we have is this compounding effect of that additional fee. So Einstein said that, compound interest is the eighth wonder of the world. But when we're considering costs, you have compound interest are working against you. And it's quite difficult for me to convey the impact that costs could have on the investment over the long term. But the one way to do it would simply be to do the calculations and take a look at the end investment value in two different scenarios to really appreciate the impact that costs can have on the investment over the long term.
Munaf, investment costs can be quite diverse. Can you walk us through some of the costs that investors should be mindful of and their implications?
Yeah, sure. So I would say we can break the costs of an investment portfolio down into three tiers or three categories. The first would be the advice costs. So this would be the advisor or the advisory practice and the fees that they charge. The second would be the administration fees. And the third would be the asset manager costs. The advice costs are broken up into initial advice fees and the annual service fee. So the advisory practice or the advisor, he or she is the one that provides the advice. They provide the initial consultations, the proposals, and they'll assist with the implementation of the investment portfolio. So there's an initial cost for that. And then the annual service fee then covers all the future consultations, the future advice, the ongoing administration and servicing of that investment portfolio. The second category, which is the administration costs, they are the cost of the product provider. So which product provider or an administrator will we use for the investment product to set up the retirement annuity or the unit trust? And the administration is essentially it's their product, and they'll provide you with investment statements, the tax certificates. If you want to make withdrawals or ad hoc contributions, they'll have their admin team that will execute those instructions. They probably will have a portal that you can go online and track your investment portfolio. So then there's an administration fee for that. The last category would be the investment portfolio, the asset manager fee. And that fee is for the underlying investment portfolio. So this company or these fees are to cover the costs in the research and the execution that goes into selecting the exact underlying asset assets that generate the return. So which shares or bonds are we going to invest into to try and outperform the market? And there's then a cost for that. So those are the three categories of costs that one could expect when setting up an investment portfolio.
Munaf, just an extra question there. Is there a certain percentage or a standard percentage that is charged for each of these fees, or does it differ for every investment and every asset manager?
So the initial advice and the annual service fee, which is the advisory practice, the maximum as per regulation is 3% as an initial advice fee. Generally, it's rare for an advisor or the advisory practice to charge above 1.5%. So that's kind of the norm in the industry, for that to be the cap, unless there was an excessive amount of time and hours invested into the client and the planning process. But 1.5% is usually the cap. The maximum as per the regulation for the annual service fee is 1%. And that usually is calculated or could be applied on a sliding scale. So the higher the capital or the investment amount, the lower the annual service fee. In terms of the administration, usually, this would be a generalization, but I would say 0.5% would be what the administration costs are. And that is also applied for a sliding scale structure. And the asset manager fees, that can vary from about 0.5% for the portfolios that are referred to as a tracker portfolio, where they just track a certain index or the market. Those are generally cheaper, but there's no strategy involved. And then it can go up to about 1% or so, 1.5% for the equity and the global funds. And then you get hedge funds, which are even more costly at about 2.5-3%, which includes the performance fees.
Thank you for that. Now let's discuss choosing cost-effective investment vehicles. How do the choices investors make in this regard influence their overall costs?
So with this, I think there's an important point to bring up, which is, within the industry, we sort of categorize investment products. And I think this is unofficially, but we categorize it as old generation products and the new generation products. And I think this is an important point to share, because there's a big difference between these two categories of products. The old generation products are the ones that have higher costs generally. These are the products that if you have a debit order and you cancel the debit order, there's a charge for that. Or if you cancel and terminate the product, there's a termination charge for that. These old generation products, they will have complicated fee structures, often or sometimes could have a cashback at the end or something like that. And they'll have a limited selection of portfolios often. So overall, all generation products aren't the best and the most cost-effective option. And this was a big thing in the industry a long time ago, that these products are high in costs. And therefore, slowly, as the industry progressed, all the companies started coming out with what is referred to as the new generation products, which are a lot more transparent in the fee structure. If you cancel the debit order, there's no cost for that. If you terminate the product, there's no termination charge for that. You're able to pause the debit order and restart it in a year if you have financial trouble. But these new generation products are generally the more cost-effective ones. So if you're deciding on which investment product, just ensure that it's a new generation product that you implement, as in the majority of instances, that would be the best option.
Can you please give us examples of the new generation products that you just mentioned?
Yeah, sure. So all the companies now actually offer the new generation products, even the life companies that only used to offer the old generation products in the past. They've also now all have their new generation platform. So it's not a specific product, but it could be a retirement annuity product. Or we could use any insurer, but they now have their new generation platforms as well. So you could get the Sanlam Glacier retirement annuity or the Ellen Gray retirement annuity, which are the new generation products where the fee structure is more transparent. And then you get the life retirement annuity products, which would have the more complex fee structures, the cashbacks, higher costs involved, and so forth.
Just staying on cost effectiveness, what cost saving strategies are available when constructing one's investment portfolio?
So when constructing the portfolio, as an advisor, the cost that we can try reduce and be cost effective would be the product provider, so the administration costs, and the investment portfolio costs. Now, in terms of when you're discussing with the client doesn't have too much information on the investment portfolios out there. There are hundreds of investment portfolios out there, all with different cost structures. And to be honest, even an advisor cannot keep up to date with the investment portfolios that are available. And often advisory practices actually outsource the function to experts that keep up to date, and that's their primary function, is to research all the investment portfolios. So there's not too much to say about the investment portfolios, but I would suggest that as a client, to at least have that conversation with the advisor to understand how the advisor is attempting to be cost effective in their investment portfolio selection. So that's to do with the investment portfolios. When we consider the product provider or the administrator, there are a few ways to select a product provider that would be more cost effective for your particular circumstances. And there's two things that I would suggest you to consider when selecting the product provider. The two things would be the sliding scale that the administration fee would be applied on. So how does that sliding scale work? And the second is aggregated pricing, which I'll explain just now. In terms of the sliding scale structure, so in the majority of instances, 0.5% is where the admin fee begins at. And then there would be a sliding scale. So the higher the investment amount, the lower the admin fee. So depending on your investment capital that you have, that you'll be investing, a certain sliding scale may be more cost effective than another sliding scale. So it would be worthwhile to do the calculations to see which sliding scale structure from which provider would be the most cost effective for the capital that you have that you want to allocate to the investment. In terms of aggregated pricing, so aggregated pricing is where there are some platforms where if the client has a retirement annuity product as an example and a unit trust investment product, they will then apply the sliding scale structure and the admin fee independently to each product. So they don't combine the assets. They'll apply the 0.5% admin fee to the retirement annuity, and then they apply the 0.5% to the unit trust and the sliding scale to each one independently. So it will end up being a higher cost overall compared to if the investment company or if the product provider said, okay, you're one client that has two products, we'll combine the assets. And you have 100 Rand in your RA, you have 100 Rand in the unit trust, let's combine it. And you have 200 Rand altogether. And now let's apply the sliding scale to the 200 Rand. And generally that would result in a lower admin costs. In addition to that, the product providers have tried to be more competitive in recent times, and they've extended that aggregated pricing now to not just products, but into various ways. As an example, they'll say there's now aggregated pricing between a husband and a wife. So between our partners now, if the one partner has a retirement annuity and the other partner has a unit trust, the product provider could aggregate both individuals' investments and apply the sliding scale on that. Or it could be aggregation between a parent and a child. Or there's a platform that even aggregates between an individual's offshore products and the local products, because generally a local investment product would have a separate structure, a separate admin fee, and the offshore product would have a separate fee structure. But now there's now aggregation between the local and the offshore products. So depending on your objectives, if you're a single individual setting up a local product and an offshore product, well, then use the platform that will aggregate across the two. If you're two partners that want to invest together, then use a platform that will aggregate between the partners. Or if it's parent and child, the same thing. Use the platform that will aggregate between parent and child. So those are the ways to be cost efficient when structuring the client's investment portfolio.
Munaf, another crucial aspect that is often overlooked is tax efficiency. How can investors optimize their tax strategies to minimize costs?
To be tax efficient, this is quite a broad answer, because To be tax efficient, people can do a full qualification on tax. So I do have a few things I would like to share, but I think it's important to highlight that to really be tax efficient, it would be very beneficial to seek expert advice on the subject, where the professional or the expert can ask the right questions, understand your financial position, your circumstances, the objectives, etc., and then provide advice on how to achieve the tax efficiencies within your financial portfolio. But that being said, there are a few simpler ways to achieve tax efficiencies, which I think everyone should be aware of. The first would be simply use a retirement annuity, which I'm sure everyone is aware of. A retirement annuity is very tax efficient because of the tax deductibility of the contributions. So what that means is, if you're earning 100 Rand for the year, the tax that you would pay SARS would be calculated on that 100 Rand. But if you take 20 Rand and put that into a retirement annuity, then according to SARS, your taxable income is actually 80 Rand for the year. And you'll therefore pay tax on 80 Rand as opposed to 100 Rand. So that's where the tax efficient comes in, and that's where the tax deductibility refers to. Secondly, I would suggest also using a tax-free savings account. It's important that a tax-free savings account is also seen as a long-term investment. This is where all the growth within the investment is tax-free. And in several instances, I've seen people where they want to have an emergency fund or a short-term savings, and they'll set up a tax-free savings account and start contributing to it. And then in a couple of years' time, if they need the money, they'll make a withdrawal from their tax-free savings account. This isn't ideal, because with a tax-free savings account, initially, because of the limits in annual contribution, which is 36,000 Rand per year, initially in the first few years, there's not that much growth in your tax-free savings account. So you're not really gaining that much of an advantage from the tax-free aspect. So it's important to see the tax-free investment as a long-term investment where it potentially even supplements your retirement income. Because if you keep contributing to the tax-free savings account and you allow that compound growth to continue over probably at least a decade, if not more, and then you reach your R500,000 Rand cap over about 15 years, beyond that, you've now accumulated a significant amount in the tax-free savings account. And thereafter, all this significant amount of interest or growth now is all tax-free, and you could effectively withdraw tax-free income in the latter years of your life. So view the tax-free savings account as a long-term investment and not a short-term savings. Then also when you invest, so generally when we're looking at investment products, there's two investment products that are commonly used. The one is a unit trust and the second is an endowment. And quite simply, a unit trust, the returns are taxed at the individual's marginal tax rate. An endowment, the tax rate is at 30% within the product. And the product provider deducts the tax on your behalf and pays it over to SARS. So if you're an individual in the 18% tax bracket or the 26% tax bracket, then I would rather use a unit trust because you're getting taxed at your tax bracket, which is 18% or 26%, as opposed to the 30% within the endowment. If you're an individual, a high income individual in the 41% tax bracket, as an example, then use the endowment structure because now your growth can be taxed at 30% within the endowment rather than your tax bracket of 41%. That being said, it's important also to remember that we are all entitled to interest exemptions and capital gains exemptions every year. So the interest exemption is 23,800 Rand. So the first 23,800 Rand of interest that we earn is tax-free, and the first 40,000 Rand of capital gains that we earn is tax-free. So within an endowment, you cannot use your exemptions, but a unit trust, you can use those exemptions. And you can trigger that capital gain every year to use that capital gain exemption. So if you haven't used those exemptions, be tax efficient regardless of your tax bracket and use the unit trust to make the most of those interest exemptions every year. And the last tax efficient strategy that I would like to share would be for those that are retiring, that are close to their retirement now, and they're looking at withdrawing a lump sum from their retirement savings. There's a tax table that's applied for the lump sum that you withdraw. And generally, it's 550,000 Rand that is tax-free. But it's important to remember that 550,000, that tax-free portion, it could be more or it could be less than the 550,000 Rand. The reasons for that, in short, I'm not going to get into the explanation and how it works, but in short, it's due to excess contributions that you would have previously made that will result in a higher tax-free portion that's available to you, or previous retirement fund withdrawals that will result in a lower tax-free portion that's available to you. But at retirement, it's important to determine that with the tax directive simulation so you can then plan your retirement income plan in a tax-efficient way. So those are, 4 tax-efficient strategies.
Munaf, as we wrap up, what final advice do you have for investors looking to manage their investment costs more effectively?
I think, since we've been talking about costs quite a bit, it would be, my last piece of advice would actually be somewhat contradictory in a way. So, of course, it's very important to try and bring down the costs as much as possible. But at the same time, it's important to remember that it's the final outcome to you as the investor that's important. So as an example, when we construct a client's investment portfolios, we would often include hedge funds. Hedge funds have a very high cost generally because of the performance fees. So you can often see hedge funds charging a fee of about 3 or 4%. But if you look at the last 10 years, certain particular hedge funds have outperformed the market, and they've done so with the lower volatility, which for us is great because we can then offer our clients, or we can potentially generate higher returns for our client with reduced volatility. So even though there's a high fee, we still include them because the end result is more positive for the client. Another example is when we're using a product provider, it's again about the service that we receive and the client receives as well. So if it's a slightly higher fee, but you're getting amazing service, that's gonna reduce your stress and your anxiety. Well then great. Or if you're dealing with 2 financial advisors, and the one provides you with a detailed analysis and provides you with clarity and is able to answer all your questions and gives you great advice, and the other one hasn't provided you with the detailed advice, and the first one charges a slightly higher fee, it may be a worthwhile to go with the better advice and the better advisor and pay the higher fee. So it's just important to find the balance between the service and the end result that you receive as an investor and trying to reduce cost where possible.
Thank you for joining us on this episode, Munaf, and sharing these very valuable insights with us.
My pleasure. Thank you, Tommy.
That was Munaf Mukadam, who is a certified financial planner at Greenwich Mahura Investments. If you enjoyed the show, please make sure to follow us for the latest episodes, share the podcast with your friends, and download our episodes.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.